Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell this week. So let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Dollarama missed estimates for fourth quarter same-store sales. The Montreal-based company also raised its dividend, which came in slightly below estimates. The discount store says unfavorable weather conditions negatively impacted store traffic during peak sales periods. Dollarama says it reached new customers through the opening of 75 new stores. Boralex is confirming it is conducting a strategic review of the company. According to Bloomberg, the renewable energy company is also weighing a potential deal to go private. The Montreal-based company is working with Canadian banks to handle proposals. And according to people familiar with the matter, the deliberations are early and the company could still decide to remain public. The European Union and Australia have signed a free trade deal. Both sides will eliminate tariffs on almost 100% of EU exports of goods. Certain steel products and some EU farm produce will be exempt, though. The breakthrough comes after 2 years of negotiations as both partners seek to diversify trade and reduce economic reliance on China, as well as exposure to U.S. uncertainty. Speaking of the U.S., we'll start with the U.S. futures today, taking a look at the stocks flip-flopping after what we saw yesterday. The Dow, the Nasdaq, S&P 500 all down this morning in early trading by about 0.5%. And we're watching the TSX closely as well. It's had an interesting start to the week yesterday after a bit of a loss the week before. You can see it ended the day just under 32,000 points. We'll be watching to see what happens today. Oil, meanwhile, is back above $100 U.S. a barrel, climbing after Tehran ruled out direct talks with Washington to help resolve the Middle East conflict. Now, the rebound follows Monday's sharp sell-off. So what does this mean for the broader market? Let's get some perspective now from Scott Kronert, head of U.S. equity strategy at Citi. It's good to have you join us. Good morning.
Hi, Lindsay. Good seeing you.
So markets, they were broadening out earlier this year. You've made note of that. How is the war in Iran really kind of weighing on your outlook now?
Well, the broadening argument really was a function of sort of a Goldilocks economic backdrop where you have soft landing economic conditions and an easier Fed. And that what was intended to promote, I think, a broadening in terms of earnings growth across different sectors and even down into U.S. small mid-cap. What's happened with the backup in oil prices as a function of the Iran conflict is that you've begun to bring into question some of the premise for that broadening playbook.
We've been looking throughout the last couple of days and weeks in terms of how this price of oil is really going to affect basically everything. When it comes to the next earnings season, how do you think the price of oil will affect things there?
Well, the way we think it plays out here is over the next month or so, we have to continue to work through the Iran conflict itself, and we're watching the oil futures curve pretty closely on this. But what we think happens as we go into the Q1 reporting period is that we'll probably get another set of solid earnings results, much like we saw with Q4 reports. But the difference this time is we would expect that most corporates will be a little bit cautionary in terms of their outlook as a function of the uncertainty that's kind of unfolding on the backs of the Iran conflict and higher oil prices. And
you talk about that uncertainty, like now we're seeing, as we mentioned in the lead into Tehran denying that it's had any talks with the U.S., despite Donald Trump saying that talks have been happening between the U.S. and Iran. Like, is that an added layer of uncertainty for investors, or does it really come down to prices?
Well, I think as we've been going through this for the past 3, almost 4 weeks now, I mean, the news flow, obviously in and of itself, is fairly uncertain, if you will. But I think what we're really focused on here is duration of conflict, and then therefore the duration of the spike in oil prices and the degree to which oil prices remain higher for longer and then relative to previous expectations. And it's that relative to previous expectations that really matters. So we expect that we're going to go back and forth. It's very hard to predict the actual timing on this. And I think most investors are in that same camp. So where we're focused on is my point here is that, we went into this year looking for an oil price deck, probably on WTI in the mid 60s, and now we're looking at a futures curve that takes it in roughly $10 higher. So what that does is begin to feed through sort of the inflation mechanism, the product pricing mechanism, and we think ends up having sort of an overhang issue on an otherwise fairly healthy consumption picture.
There are other factors, though, that you've highlighted apart from the Iran conflict that might be affecting markets, that might be affecting earnings season when it comes around again. So you mentioned private credit uncertainty, AI disruption, and funding concerns. Are any of those three a standout to you, or do you want to go through all of them and how they might affect things going forward?
It's a long list, right?
Yeah.
So I'd say the Iran conflict and oil is most topical right now. We kind of argue that has almost sort of a black swan potential there if this does persist for much longer. The private credit issue is more of a tail risk that we think is more or less contained, but we do need to factor it into our outlook. And then the AI disruption narrative, which was front and center just a month or so ago, is still out there, but that's a longer term issue. So we go back and forth on the AI playbook in terms of a productivity positive relative to a disruptive negative, and that's going to play out, I think, with different puts and takes. The tariff discussion is still in the background. That is less resolved as the Supreme Court overruled some of the IEEPA tariffs. So what my point here is that we've got a series of issues that have not really been resolved, and we expect that as we go through this next 1 to 3 month time frame, we should begin to get a little bit more comfort that we have a better line of sight to how those unfold. So in the meantime, the high level takeaway here is that expect uncertainty to prevail. We think it manifests in the Q1 reporting period, and it kind of keeps us a bit more focused on the risk elements of U.S. equities right now relative to the reward that we might see coming out the other side of some of these.
With that in mind, are there any sectors that you think could still outperform through all of this, or sectors that maybe investors in the meantime, as you say, could go to as almost a safe haven?
Yeah, we've been arguing the U.S. as a relative safe haven versus rest of the world. And then within that, it's the mega cap growth tech cohort that we think is sort of arm's length from certainly the oil price issue. The fundamentals here, I think, are fairly visible around the AI build-out storyline, and we've seen that in terms of the earnings revisions, particularly on the semiconductor space. And in the case of software, which got a lot of negative press earlier this year, we think that's been finding bottom with a lot of the terminal multiple issue now priced in. So where we're going with this is U.S. We think is set up better than the rest of the world right now. And then within that, it's this mega cap growth tech component of the market that we think can be a little bit more of a relative safe haven as we navigate some of the more apparent macro concerns right now. And
just lastly, I take your point on the mega caps, but what are your thoughts on small caps compared to maybe larger caps?
Yeah, so the small caps were an important call for us going into this year and as part of this broadening playbook. But again, that's where we were fairly reliant on this soft landing, easier Fed scenario, which is now coming into question as 10-year yields back up. The line of sight towards future Fed eases is a bit more complicated right now. And then, the economic sensitivity of small cap is always sort of a given here. And so it sort of is the poster child for where you would expect to see a lot of the negative macro influences of the oil price read through related tariffs and other factors come to play. So we're essentially stepping to the sidelines on that small mid cap broadening call for now, hoping to revisit in the next couple of months.
Okay, we'll leave it there. Scott Cronert, head of the U.S. equity strategy at Citi. Appreciate your time. Thanks so much.
You bet.
Coming up, the latest on conflicting messages from U.S. President Donald Trump and Iran on whether talks, or any talks, were held. Stay with us. Both the S&P 500 and the TSX saw significant jumps yesterday after President Donald Trump said the United States had talked with Iran about a possible end to the war. CTV's Tyler Barrow has more on how all this has been affecting prices here at home.
As President Trump says a deal to end the war with Iran may be close, the markets take another big swing. On Monday, Canadian and U.S. markets rose sharply as the positive news gave investors a reason for optimism.
It's going to go in every direction, depending upon the rhetoric, the conversation, and potentially negotiation and agreement at some point in time.
Trump says he will postpone hitting Iran's energy infrastructure for 5 days to allow for negotiations. Investors are watching closely.
Definitely pay attention to it quite a bit. I would say it is a bit concerning.
Very concerning, and I wish I could say I was doing something more active, but honestly, mostly trying not to think about it.
Definitely is affecting my investments. I'm concerned in the short term, but in the longer term, I think it might be beneficial.
As turbulence moves the market up and down and up again, financial experts are telling their clients to consider their timeline and risk tolerance.
Really understand that if you're down 20, 30%, is that comfortable to you given the position that you may have, given what's happening in the market?
While the markets are up, West Texas Intermediate oil dipped below $90 a barrel on Monday. Throughout the city, fuel ranged in price as Gas Buddy had the lowest pegged at $1.49 a liter. Other stations selling for over $1.75. As oil prices fell, drivers should expect gasoline prices to follow.
Come Wednesday, gas prices are going to fall net 14 cents or more a liter. Diesel could fall as much as 19 cents a liter.
Good news for those trying to cut costs.
Trying to avoid road trips as much as possible and just trying to stick around from closer to home and potentially carpooling.
Tyler Barrow, CTV News, Calgary.
And Donald Trump has put an ultimatum to Iran on hold, claiming that talks on ending the conflict have been going well, but Iran denies any of these talks have taken place. ABC's Rachel Scott has more on that.
This morning, conflicting messages from the U.S. and Iran on whether talks to end the war are taking place.
We have had very, very strong talks. We'll see where they lead. We have major points of agreement. I would say almost all points of agreement.
But Iran insists that no talks with the U.S. have taken place, saying anything otherwise is an attempt to influence the stock market and the price of oil. President Trump now giving the country until Friday to make a deal to end the war, backing off his threat to hit and obliterate key Iranian electrical plants if the country did not reopen the Strait of Hormuz by last night.
We're doing a 5-day period. We'll see how that goes. And if it goes well, we're going to end up with settling this. Otherwise, we'll just keep bombing our little hearts out.
4 weeks into the war, the Strait of Hormuz, where 20% of the world's oil flows, is still at a virtual standstill. President Trump insisting if a deal is reached, the strait will reopen.
And who's in control of it? Will Iran still be able to control the flow of oil?
Be jointly controlled.
By who?
Maybe me. Maybe me.
You want the United States to be in
me
control
and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and it'll also be a form of a very serious form of a regime change.
The president says his son-in-law Jared Kushner and special envoy to the Middle East Steve Witkoff are leading the ongoing talks with Iran, but he will not say who in Iran they are talking to.
We're dealing with the man who I believe is the most respected and the leader. It's a little tough. We've wiped out everybody.
Is that the Supreme Leader?
No, not the Supreme Leader.
Rachel Scott, ABC News, Washington.
After the break, we will get the latest from CERAWeek, where some of the biggest energy leaders are weighing the future of power, climate policy, and grid reliability. Up next, Constellation Energy CEO Joseph Dominguez. From nuclear power to the future of the U.S. energy grid, few companies sit at the center of the energy transition like Constellation. Earlier, we got perspective from Constellation CEO Joseph Dominguez, where he discussed energy prices, natural gas, and data center demand. Have a listen.
As a domestic electricity producer, natural gas pricing in the U.S. isn't really dramatically affected. We're already shipping every molecule we can of LNG, so there's not going to be an uptick of natural gas leaving the country until new facilities are built. So the price of natural gas has been relatively stable. We don't use oil to make electricity except during the dead of winter, and we're already past that period of time. So we're seeing some stability. In the long term, we're worried about what everybody else is worried about. Supply chain issues, different things, as we think about the implications to Asia, which will be, of course, more significant.
So right now, the long term is more of a bigger problem for you.
Yeah, I think that's right. It's both a problem and an opportunity, I would say.
How is it an opportunity?
Well, look, I think, before when we were thinking about the data economy, where all the data centers are going to go, there was a pretty good debate that a lot of the data centers were going to go to the Middle East. We had already seen agreements to transfer chips to the Middle East for the construction of data centers there. Unless we end up with, really a solid peace in the Middle East, which seems, unlikely, at least based on the history we've all lived together, I think people are going to start to have second thoughts about citing major new infrastructure projects in the Middle East. I don't think Europe is in the game for these data centers, so that means more data centers in the U.S. as the data economy builds out. As an electricity producer, that means more customers that we're going to deal with. I think the same is true for our industrial customers that already were moving from Europe to the United States. These pressures on international energy prices are all going to drive people to North America.
And you just touched on this, but also nuclear power, extremely popular right now because of data centers and AI. So what are the different ways you can capitalize on that?
Well, the first thing we got to do is lock down the existing fleet and make sure that we could operate it safely for as long as we can. That requires a good deal of investment. Having these agreements and having this social acceptance of nuclear and this kind of passion around nuclear means that we can make billions of dollars of investment to keep the fleet the way it is, operating for a much longer period of time, also increasing the output of the fleet. We think we could get as much as 6 or 7 brand new nuclear plants worth of energy just by uprating the existing fleet. We're busy underway doing those things at Constellation. And then the last piece of it is actual new nuclear, whether that be small modular reactors or large machines. So, in all three areas, securing the existing fleet and the capital investments needed, increasing the output of those units, and building new units alongside of those, we're very active.
When you power data centers, you also have consumer bills. So how do you balance that need for data centers and its effect on pricing while keeping reliable and affordable power? We hear a lot of people saying, not in my backyard.
Yeah, and look, I think this is an evolving conversation. I think the early days are data centers are takers, and they're driving up the cost of energy. And that is driven by this. Peak demand, which is a handful of hours, call it 40 of the 8,000 hours we have in a year, are constrained. And we're seeing higher prices in those hours as data center demand has come on. The president is addressing that through executive order, and the data economy customers have agreed to be flexible at that peak or bring their own capacity resources at the peak. If we manage the peak, we want the data centers on the grid. Why is that? Because think about it. All the wires we've built, all the way down your streets, all the big transmission lines you all see, are dramatically underutilized with the exception of those 40 hours. If we could get more electricity running through those wires during these periods where the system isn't being utilized, that means we could collect rent or tolls on those lines through these customers, and we could actually reduce costs. Coming into this CIRA session, very different than last year, are big think tank reports that are saying, hey, if you do this right, data centers actually drive down the cost of electricity, not up.
But if you do them right and data centers drive them down, what do you do in the meantime? Because it's not going to be immediate.
In the meantime, you have to use other tools. So in the meantime, here's what we're thinking about. We've been working with some of our other industrial customers to voluntarily reduce demand during these peak hours. So we're able to curtail certain customers, have the data economy customers pay them to do that so that we get that same flexibility on peak. The next up in terms of available generation are the backup generators at the data centers. How do you use them more effectively as a grid resource? How do you use batteries as a resource? And then as you look at 3 or 4 years out, that's when you're thinking about new gas-fired generation.
There's a lot of concern about a possible crash or at least some type of correction in the AI market and data centers. What's Constellation read on this?
You know what? I think people think because they're our major customers that we have some independent forecast. The reality is this. I am looking at what they are spending. They know their business. They know the demand. So as long as the capital expenditures on data centers is continuing to climb, as it has, that is the best signpost for me to gauge the growth of my own business. We're not kind of separately going out there and evaluating AI and whether we have a bubble. What the data economy customers are telling us is that demand is increasing because they're building more and more.
Okay, we're going to take a look at U.S. futures as we count down to the opening bells. We'll start with the U.S. futures. Stocks are tumbling today. You can see here the Dow future, the NASDAQ, and the S&P 500 down by almost a full percentage point as investors start to juggle all these headlines around the U.S.-Iran war. If we take a look at the TSX, it's a similar story here. The TSX gaining back almost 600 points yesterday, but this is a one-week view of the TSX, and you can see just how much it dropped last week before seeing some gains yesterday. We'll have to wait and see whether that continues today. Dollarama could be a stock to watch today. Dollarama missed estimates for fourth quarter same-store sales. The Montreal-based company also raised its dividend, though, which came in slightly below estimates. And the discount store says unfavorable weather conditions negatively impacted store traffic during the peak sales period. So interesting to hear how consumer spending really affected these numbers. Dollarama says it reached new customers through the opening of 75 new stores, though. So we're going to be chatting about that later today. And of course, Dollarama has its earnings call coming up at 10:30 today. We'll take a look at the price of oil. Oil resuming advances today on concerns that the Middle East war may continue to escalate, with flows of crude through the Strait of Hormuz still contained. Look at that spike ever since that war started at the beginning of this month. Oil up by almost 5% at the moment. We're going to keep watching that. Also watching gold. An interesting story here. Gold snapping a losing run today as investors take stock of that dramatic sell-off that we saw yesterday. We've actually seen the metal fall more than 15% since the war in Iran began. You can see right now it's down by 0.7% to start the day. Again, watching that closely. And then we're also watching the loonie study this morning amid conflicting signals of the war in Iran. Obviously, U.S. President Donald Trump saying talks are going well. Iran saying that there are no talks. So the loonie trying to weigh all of this, investors trying to weigh all of this. But the loonie pretty steady compared to other currencies around the world. And then Bitcoin also rising this morning. It's been pretty steady this week amid all of this turmoil. So opening bells are next. We'll be right back with that. Stay with us. Here are the opening bells at the NASDAQ. The Fashion Foundation rings the opening bell at the New York Stock Exchange. Banco Macro is ringing the opening bell. And at the TSX, Go Residential Real Estate Investment Trust is opening the market. It's time now for the first 15. This is BNN Bloomberg. Trading day is just getting underway, so we're going to check in on the equity markets now that trading has begun for the day. A bit of a rocky start for the markets. The TSX is down by 0.8%, S&P down by 0.6%. Same with the NASDAQ. Investors very much watching what's happening, this conflict in the Middle East. There's a bit of an up and down this week as we hear conflicting reports from both sides. And it seems as though that is weighing on the markets. Investors not exactly sure what to do with all of the information that we're getting in. So we'll keep watching that as well. We're watching some particular Canadian stocks today. Obviously, we already told you about Dollarama, but that earnings report coming in today. And Dollarama seeing sales up year over year, but comparable sales missing estimates in the fourth quarter. And so Dollarama to start the day down by 4.3%. The company is also forecasting annual sales to be below estimates, signaling softer demand, also saying that because of the weather over the last quarter, they saw less foot traffic coming into their stores. We're watching Boralex as well. Boralex is weighing its options, including a potential deal to go private, and it has formed a special committee to review strategic alternatives. The company, it builds and operates renewable energy production sites in Canada, the US, France, and the UK, with an installed capacity of nearly 3,800 megawatts as of the end of February. Boralex up by more than 7% to start the morning. Vermilion Energy is another company that we're watching closely. It saw a sharp drop yesterday morning, finishing at the bottom of the TSX on Monday. Obviously, these high oil prices that we're seeing because of the conflict in the Middle East affecting Canadian energy companies here at home. You saw that run Vermilion's had since the beginning of the year, but as I mentioned, a sharp drop off yesterday. So we'll see if there's a bit of a rebound today. And for movers south of the border, we are now joined by Bloomberg's Janine Panzer with more. Janine, good morning. Good to have you. So what are you talking about today? The report on SMFG and Jefferies?
Yes, good morning. So shares are up this morning. Jeffrey Financial Group is opening higher after a media report suggests that Japan's second largest lender, SMFG, is considering a takeover. But sources actually tell Bloomberg that that is not in motion, as MFG are saying that it has no immediate plans of takeover. This is what our sources are telling us. Executives are conscious of many hurdles to any move to further integrate Jeffrey, including regulatory hurdles. So FMFG actually already owns a sizable stake in Jefferies and also has an agreement that allows it to build that position up to about 20%. So this speculation isn't coming out of nowhere, but right now there is nothing concrete behind it. A spokesperson for SMFG is calling Jeffrey an important partner, but one comment on the speculation. A quick look at Jeffrey. Its stock is actually down about 36% this year. The stock has been hit hard by some troubles, including, if we remember, exposure to collapsed firms like the First Brand Group and Market Financial Solutions. So Jeffrey is also reporting their earnings tomorrow, so we'll keep a close eye on that.
Also keeping a close eye on a computer networking company, Netgear. Shares of Netgear rising today as the U.S. FCC is banning wireless router imports. Tell us more.
Yes, the FCC is banning foreign-made wireless routers over national security concern, citing that these routers has some vulnerabilities in the past and it could link to cyber attacks. And this is actually could shake up the market and ultimately a good thing for Netgear. That's what some analysts are saying, because Netgear is actually a U.S.-based firm and has a more transparent supply chain. And, you know, since most routers are manufactured overseas, analysts are thinking like this could be good for Netgear. It could help it win exemptions and potentially take shares from competitors like TP-Link. So it's important to note that this ban only applies to new imports, so existing product can still be sold and used. So this looked like a potential competitive tailwind for Netgear rather than any fundamental changes to demand, Lindsay.
Okay, interesting stuff. We will leave it there. That's Janine Panzer from Bloomberg. Janine, thanks so much. Coming up, where should your money be right now as oil rallies and major index futures slide after conflicting reports on an Iran ceasefire? We'll find out with Mark Sebastian right after this. We are seeing wild swings in markets and oil prices after U.S. President Donald Trump backtracked on attacks on Iran's power plants, with conflicting reports emerging about a possible ceasefire. How should you invest, and what are the potential stocks you should look at or avoid? To break it all down now, we have Mark Sebastian, founder of Option Pit and CIO of Carmen Line Capital, joining us. Good morning. It's good to have you.
Thank you. It's good to be here.
There's a lot for investors to kind of wade through, right? Especially when you get conflicting reports on a big conflict such as this. How do you think investors should be listening to what we're hearing from the U.S. and from Iran, or should they maybe not even be listening to that?
I mean, until there are ships going through the strait, then, nothing else really matters. Markets are, these news reading algos are going to react to what they see. But, the time to jump in, the time to go, short oil, long the market when you start seeing ships pass or they're cleared to pass. And right now, that's not happening other than a few kind of, outlier occurrences. So that really just watch the Strait. If that opens up, then oil is going to roll over as quickly as it, not all the way down, but it will roll over to a much more reasonable level in a very short order.
Yeah, I think that's another thing to note as well, right? That even when this does end, given what's happened and all the infrastructure that's been damaged or destroyed, it won't return to levels that we saw before this conflict.
Well, not from 6 months ago, but prior to the official beginning of the conflict, there was already a pretty decent $5 to $10 risk premium built into WTI and Brent, based on demand, based on the output. They were trading a little rich. So I wouldn't be surprised if we got back to where we were right before some of that bombing happened, but under the understanding that that was actually already a little bit too expensive. And then long term, a year, 2 years down the line, if this works out, the lifting of sanctions on Iranian oil, that's going to eventually cause depressing effects on crude.
Okay, so that might be what happens in the future. But given what's happening right now and the wild swings we've been seeing in the markets, how much confidence do investors and traders have right now, do you think?
Well, I mean, the headline indexes are moving around a lot. And if you look at the numbers, right, the high in the S&P was, just under 7,000. We're currently trading 6,550. That's like a 5% sell-off. It's not like the bloodbath at the top line level has really been that bad. It really hasn't been a bloodbath. It's been a selling. There's more pain over in the NASDAQ, and part of the reason around that is what was actually already happening before this conflict began, and we were seeing money rotate out of Mag 7 and moving into kind of the inference phase, as my friend Hans likes to say, Hans Albrecht, inference phase, because companies that are actually going to use AI to make money, make product, those are the names that even now are still outperforming, right? The Russell 2000 is outperforming the S&P and the Qs on the year right now, and that's because they're the kind of the net winners of AI. They're not the makers, the manufacturers of AI. They're the user. Think about what the automobile did for delivery companies relative to having a horse. That's really the point we're at right now with AI and where the winners are coming out of this. The selling that we've seen there, yes, oil is at the top line, but to know that this is really over, I think you look at U.S. bond markets. U.S. bond markets have had just a massive sell-off. We've seen predictive markets and the CME FedWatch tool go from 3 rate cuts on the year to 0 with the possibility of a rate increase. That's really kind of, I think, the big story that's not being reported and not really being talked about is that move in interest rates and how that affects these big industrials, these big winners out of AI. Are they going to be kind of slowed down by the move in interest rates?
The volatility index, meanwhile, is in a bit of an unusual spot. The curve is essentially flat at the moment, despite a high level of uncertainty. So why do you think that is? And what does that tell us, do you think, about the markets?
I mean, at this point, when you look at the VIX and the relationship of VIX futures, past April and May, they've kind of thrown up their hands and say, we have no idea. There's normally when volatility is high like this, you would see VIX futures kind of think like betting on where the VIX will be in, let's say, July, August, September. You would see those betting at a significant drop in the VIX index. And right now they're really not, which tells me that, option traders going all the way out have kind of thrown up their hands at, will the VIX be higher? Will the VIX be lower? Near term, they're still pricing in, the big option traders are still pricing in some continued volatility with the anticipation, though, that we could see a little bit of pullback here in the coming weeks.
Okay, so I want to go through some of the stocks that you like and some of the ones you don't like. We'll start with some of the ones that you like. Dell and HPE. So what is it you like about these two?
I mean, so this super microcomputer story,
Yes.
you know, I still wonder whether there's a bigger story here, right? You have, and there's my dog. You have
Always welcome.
Yes, you have SMCI, which, you know, we know about it, the fraud thing. It just from a logic perspective, I don't have any specific details. I'm not talking to the FBI or anything like that. How does a company buy $2.5 billion worth of chips, and you, the seller, have no idea where they're going and how they're getting moved around? And to me, that presents some risk. So obviously, I think SMCI is going the way of the dodo. I think there's some real risk to NVIDIA. Winners out of this are the ones we know are not going to be selling to China. So you're talking Dell, you're talking HPE, that do essentially similar services, maybe an IBM, maybe an Intel, that do similar services that are going to basically be able to take all of this business that was going to SMCI outside of the illicit part that was being sold to China.
You say Microsoft is starting to get a little cheaper now as well. What do you think about Microsoft?
Yeah, I mean, you look at how far that thing has gone. Yes, they've got some issues. Copilot's not great. You know, there is threats to their software. But remember, you know, Windows, a lot of this all sits on the Microsoft platform. They have huge investments in ChatGPT. They own a significant portion of that. There's arguments that that piece alone, if ChatGPT and, you know, OpenAI turns into what a lot of people are predicting, could be worth more than Microsoft as it is. As a long-term investment, I think it's getting to the point where it's starting to be interesting. Software, there are areas where there's a real risk, like Adobe, I'm not interested in. But Microsoft is going to be around. They're going to be fine. They're kind of ahead of the curve on at least on the investing side of their business. So there's going to be a spot where this starts to look very interesting, and I'm starting to get there.
And speaking of interesting, you think gold is also starting to look interesting?
Yeah, I mean, it's basically given away the entirety of that huge run-up we had in the middle of the year, or at the beginning of the year. And we're now back sitting where we were in December. I do like it long-term. I think when the conflict ends, you're going to see the dollar pull back. That's going to be good for gold. So when we see ships going through the strait, that's probably an interesting time to get into precious metals.
And before we move on to what you don't like, I just wanted to ask you about NuScale Power Corporation as well. You think this is one that's under the radar?
Yeah, this is a long shot play. You know, they're doing small nuclear reactors. They haven't got a contract yet, but the technology is really good. It's like an $11 stock. And what we've seen now, I mean, if you look at the geopolitical risks and the environment, and there's still the overarching, you know, environmental aspect of oil and nat gas. Nuclear is the cleanest, most efficient way to do this, and these small power plants are going to be really effective in theory for AI, you know, terrestrial AI data centers going down the line, at least until we can get data centers in space, which is, you know, I think several decades away. Near term, they're going to need an efficient way of putting power into those data centers. And a company like SMR that can set up a small nuclear reactor and get it up and online rather quickly, there is a real long-term viability there. And if they come out one of the winners here, the stock's going to be worth 5, 6, 10x.
The thought of data centers in space is just wild. The fact that we're already starting to talk about that. Okay, before we wrap up here, the sectors and stocks you're kind of staying away from. We already talked a little bit about NVIDIA, but you say memory stocks in general are overbought?
I mean, look at the run-up they've had. You know, Micron, SanDisk, they have exploded. You know, the solution to high prices is high prices. That's what they've said in the commodity markets for years. Now, the process for getting into that is a little bit slower, right? We're finally seeing AMD start to have platforms like NVIDIA and be able to compete with them, and that's having an effect on NVIDIA, among other things. These stocks they've grown dramatically in anticipation of the next 3-4 years of earnings. Not saying they're going to going to roll over and crash, but they're overbought, and I don't see a lot of huge upside left in these. So if I was sitting there long holding them, I'd be looking to pair some gains here.
Is that a similar story for XLE as well?
Yeah, XLE is a direct tie to oil. It's going to have a similar path to energy. Difference being is when it pulls back, unlike oil, which it's pops and then drops. I think these companies are in a position for the next several years with the need for energy, oil getting cheaper. They're going to be a great long-term investment. But with up 50% in 6 months, I think it's moved pretty aggressively and gotten this extra risk bump out of the Iranian conflict. When that comes off and XLE gets back down to the 50s, I am a buyer.
Okay, we'll leave it there. Mark Sebastian, founder of Option Pit and CIO of Carmen Line Capital. So good to have you join us today. Thank you.
Good to be here. See you soon.
Yesterday on Market Call, we were joined by Jeff Parent, Senior Portfolio Manager at Castlemore. His focus was technical analysis, and his top picks were Great-West Lifeco, Canadian Utilities, and Pembina Pipeline. Joining us today on Market Call is Martin Cobb. He's Senior Vice President of Equities at Lauren Steinberg Wealth Management. His focus is global and North American equities, so be sure to tune in for that today, 12 p.m. Eastern. Just ahead, we will look at some of today's notable calls, including an upgrade for TransAlta. Stay with us. Welcome back. Time now for notable calls. We're going to start with National Bank analyst Patrick Kenny upgrading TransAlta to outperform from sector perform with a $22 price target. He says the company is positioned for double-digit growth through 2029, given its net load growth in Alberta. The analyst also expects TransAlta to reach agreements with CPP and Brookfield on its Keep Hills power plant this year. And Barclays downgraded Bank of Montreal to underweight from equal weight with an unchanged price target of $199 Canadian. At the bank's upcoming Investor Day, the firm expects BMO to reiterate its 15% plus return on equity target, with its U.S. banking segment reaching 12% on a run rate by the end of 2027. However, the analyst says the stock's valuation already reflects the return on equity improvement. Barclays cites valuation for the downgrade. And TD Cowen lowered the firm's price target on Royal Caribbean to $350 US. That's from $400 originally, and kept a buy rating on the shares. The analyst says as part of a Q1 earnings review for the cruise group, the firm cut 2026 earnings estimates to reflect higher fuel costs. However, the analyst sees resilient travel trends to date. And hundreds of Algoma steelworkers finish their final shifts as the company shifts to electric. We've got more on that coming up right after this. Stay with us. Hundreds of Algoma steelworkers finished their final shifts amid 1,000 layoffs tied to a switch to electric steelmaking. As employees navigate EI and a competitive job market, the city of Sault Ste. Marie is pursuing port funding, eyeing more than 2,400 jobs. CTV's Corey Nordstrom has more in this report.
Hundreds of Algoma Steel employees had their final shift over the last 4 days, part of the 1,000 job cuts related to the company's early switch to electric steelmaking. Today, dozens took part in sessions to learn more about employment insurance.
I don't know if I'm going to get called back. I don't know if I'm going to go back to school, so at least get this on the go. I mean, if I stay on unemployment for a couple months, maybe I get something sooner than that. Just kind of get the ball rolling, at least set myself up for what's coming next, and then go from there.
Workers like Prevo are also stressed that their former colleagues are now competitors in the job market.
There was, from the one union, there's 900 people laid off and 150 from the other. Yeah, that's a lot of people you're competing against for a handful, I mean, maybe a little more than a handful of jobs, but there's only so many mines out there that are only going to hire so many people, and some people aren't going to get them.
The Port of Sault Ste. Marie is one way that City Council hopes to bring back jobs to the community. If the project receives funding from upper levels of government, it could operate over 2,400 jobs when fully functional in a few years' time.
The construction jobs would be 1,400 to 1,800, depending on when the work was being undertaken, almost immediately. And so that would be a good bridge for those 1,000 workers that are being laid off in the short term, if they were interested in construction style jobs for the port.
With those levels of government investing hundreds of millions of dollars into the company's transition to the electric arc furnace, Shoemaker says it's right that they be part of a solution to find those 1,000 workers a suitable job in a project that he believes will contribute to the region and country.
Federal government, provincial government can't simply allow that transition to see those jobs evaporate. It will not have been a success if that happens.
The city has already submitted funding applications for the port project and hope to hear back shortly after the April deadline. Corey Nordstrom, CTV News, Sault Ste. Marie.
Coming up, we'll have your latest headlines and update you on the markets, including Dollarama, which posted comparable sales that missed estimates. More on that coming up. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Boralex are getting a boost today after confirming it is conducting a strategic review of the company. There's also a report from Bloomberg that the renewable energy firm is weighing a potential deal to go private. According to the report, Boralex is working with Canadian banks to handle proposals. Shares of GoEasy are trading higher today. The Canadian firm has won concessions from its lenders to keep key funding lines open amidst weakness in its auto lending business. That unit saw a surge in loan losses. GoEasy is also delaying its earnings report. Earlier this month, it suspended its dividend, withdrew guidance, and disclosed about $331 million in charge-offs and write-downs for the fourth quarter. Agricultural land prices across the country continued to climb last year. However, some regions saw more of an increase than others. According to a report by Farm Credit Canada, farmland values rose more than 9% in 2025, extending a three-decade upward trend. The federal corporation says the market was supported by farmland's long-term investment appeal, tight supply, and strong competition. We'll take a look at the TSX to start the day. It is down by 0.4%, erasing some of the gains that it saw yesterday, gaining almost 600 points by the end of yesterday. After a tumultuous week last week, we're going to continue to watch the TSX because this is part of a larger story, of course, including what we're seeing in the U.S. markets when it comes to investors and traders wary of what we're seeing throughout the Middle East, conflicting reports coming from the U.S. and Iran. And we're seeing that U.S. markets trading down this morning as well. And we are watching shares of Dollarama today after the Quebec-based dollar store chain posted revenue growth from established locations that missed estimates. Our next guest says, given the high bar expectations, the stock could see some softness today. So let's get more now from Dennis Tyfair, portfolio manager at Caldwell Investment Management. It's good to have you join us. Good morning.
Thanks for having me.
What are your initial thoughts on the numbers that we're seeing from Dollarama today?
So again, high expectations. This is a company that continuously delivers pretty strong results. And going into this quarter, I think the results have been, well, the expectations have been brought down a bit, knowing that there would be a bit of noise given the difference in weeks and how Halloween kind of fell in one quarter to another versus year over year. So the expectations were a little lower, but the company even missed on that somewhat. So The same-store sales, which is really the main metric that most analysts and portfolio managers will look at when you look at these types of companies, was a little softer than expected. Having said that, the company did point to some softness on traffic due to weather, but the basket size was slightly better than expected. So overall, they came in at about 1.5%, I believe. The expectation was about 2.6%. And again, these numbers were slightly lower than what we've seen in previous years. So it was, I'd say, a weak quarter for Dollarama, but not a terrible quarter by any stretch.
And as you say, like traffic was down by 1.6% year over year. That's according to Dollarama. But the company is also forecasting annual sales to be below estimates, signaling softer demand. Is there like a bigger story here in terms of consumer trends and spending and what we're going to see as we head further into 2026, or not really?
A little hard to decipher, but we tend to like a company like Dollarama in just about any kind of an economic environment. Dollarama's got a great business model, so it's a really good growth company. It's very well run and just a fantastic model. And having said that, in harsher times, people will tend to kind of trade down, and so that should help drive more traffic into their stores. So it's a really good core type investment because it really can weather just about any type of economic environment. But having said that, it's all about expectations. And again, this company's been growing at some very good, healthy rates over the last few years, and we're just seeing a bit of a softer patch here, on a go-forward basis. And I think a lot of that will have to do a little more with the growth profile now starting to shift a little more to newer markets, and there's probably a little more investments required into these markets, and that will probably have some pressure as well on their margins over the next few quarters. So the operating leverage we're used to seeing in the business model might be under a little bit of pressure here over the next few quarters.
Okay. So let's take a larger look at the markets now, just in general, because in your notes here, you say you started the year with a constructive outlook, but now you're a little more cautious near term, given everything that's been happening. What's your take on what we've been seeing, especially over the last week or so, in terms of the markets moving up and down? There's been quite a bit of volatility.
Just the last 24 hours, there's been a lot of volatility. So, that's going to be, I think, the kind of the environment over the next few weeks, just a lot of volatility. It doesn't seem like there's any kind of resolution in the near term. So I think the U.S. just miscalculated their ability to basically go in and get this done within a couple of weeks, get this done very quickly. And so the longer this drags out, obviously, the bigger the impact it will have structurally on energy costs, and that will have some negative impacts, obviously, on inflation. It'll have inflationary pressures going up, but as well, it will create a headwind from a growth standpoint. It is basically a tightening of financial conditions for consumers, and again, that lower end consumer is probably the one that will really feel the brunt of it. And so we do expect the longer this goes, the higher the risk for the markets, and then just the tougher it becomes for central banks to really try and manage this, because this is really a supply shock, driven inflation, and central banks have very little ability to kind of have any kind of impact on supply shock inflation. So it puts them in a tough position. They'll be trying to fight inflation, and they'll probably have headwinds to growth on the other end of that. And so it just creates more volatility. And given how the markets were trading at pretty high multiples, we've had a really good run for a while. This does kind of set up the market in the near term for somewhat of a correction.
Somewhat of a correction, and we might be seeing that already, even in the price of gold, for example. I'm wondering if there's any interesting stories that have been jumping out to you, because obviously the price of oil is the obvious implication here because of what's happening in the Middle East. But what we've been seeing with gold, what we've been seeing with other metals as well, natural gas, it's been really interesting to watch, particularly the price of gold, I think, just going up and down, even as you say, over the last 24 hours.
It has been. I think that whole commodity segment is going to be very volatile. It's where you see the most volatility, and it'll be very volatile over the next few weeks until we get some form of resolution. We still think from a long-term standpoint, we do think gold is still a valid investment. We still like the fundamentals of copper longer term. And if anything, we do think that the fundamentals for the energy sector are improving through all this, because we do think there will be some structural damage to the supply side of the equation when it comes to oil and natural gas. And so that will basically lead to a higher base level pricing on a go-forward basis. So overall, longer term, we still think these are good areas to invest in. But the next few weeks are going to be very volatile on either side of that trade.
Mm-hmm. Okay, speaking of good areas to invest in, you have some stock picks, and we want to get to those now. So your first one is Hammond Power Solutions. What is it you like about this company?
Yeah, so Hammond Power Solutions, they do dry transformers. So whenever you need to you invest in any kind of building and stuff, you need to basically connect it to the grid, and you need transformers to basically step up and step down that power. So they basically manage the power. We're seeing significant demand from data centers, as well as from the EV network expansions and so forth. And so the secular demand tailwinds are very strong. The interesting part is this company, the stock back in 2024, kind of hit $154 and kind of had problems kind of breaking through that over the next 12 to 18 months. And that was mainly because everybody knew the story was good, that demand was there, but their capacity to kind of be able to supply that demand was not there. They've made significant investments, and we're really starting to see that kick in. So if you look at their most recent quarter, their top line growth, revenue growth was something like 22-23% year over year. But more importantly, their backlog growth was like 170% year over year. So, or 120% year over year. So it's basically, we're really starting to see that demand flow through, and that's really based on they've been able to expand their capacity with a new plant in Mexico, and they're making new investments this year to expand their capacity by another 100 million. So now they're really in a really good position to be able to fulfill the demand coming down the pipeline, and they're seeing a very strong pipeline of demand, especially on the AI data center build out.
Your other pick, Stella-Jones, has had quite the run recently, up the most in 7 weeks, beating gains on the TSX. What's going on with Stella-Jones?
Yeah, we like Stella-Jones. It's almost like a utility type investment. Now it's a materials company. It's basically a lumber company. They do mainly the railway ties and utility poles for utility companies. So those two markets are really driven by just maintenance and replacement cycle. A good part of that, about 90% of their sales are basically maintenance and replacements. So it's not like that part of the business has a lot of exposure to the economic cycle. It's fairly steady. They've also got long-term contracts, and they've got pricing mechanisms in there to increase pricing. But we also like the pole business quite a bit because, again, there's a lot of investments in the grid modernization and the grid hardening, and that really plays into that business of theirs. And whenever you replace a telephone pole, grid hardening, usually means you'll need to basically have slightly bigger poles and longer poles, and that just replacing that one pole usually represents about 15% increase in fiber. So you've got growth just from that perspective. And they've just made a couple of really important acquisitions that basically opens up a whole new market on the transmission side. So you're looking at the lattices for transmissions and so forth. So they're a small player in that market. It's very fragmented. There's plenty of opportunities to consolidate it, which is really part of their DNA. It's what they've done historically to become the two dominant players in the two markets they're in now. And there's a lot of organic investments opportunities in these new areas as well. So we think they're well positioned for growth, and the bulk of the business or the core business is a very steady business that we like in a volatile economic environment.
Okay, we'll leave it there. Dennis Taillefer, Portfolio Manager at Caldwell Investment Management. Thanks so much for joining us. Appreciate it.
Thanks for having me.
Coming up, we will put the spotlight back on CERAWeek, one of the world's most influential energy conferences, with an interview with Nextera, one of the best positioned companies for AI-induced electricity demand. That conversation's coming up next. Welcome back. We are taking you back to CERAWeek, one of the most important energy sector conferences, and we got some perspective on the growing power demands facing the world's largest renewable energy producer, Nextera Energy, in an interview with CEO John Ketchum. Take a listen.
There's so many opportunities, around artificial intelligence and huge power demand. It's a big, big driver of power demand for us going forward. And we're an all the above energy company, so we're a leader in renewables, leader in battery storage, leader in gas-fired generation and nuclear as well. And so I think we can provide the perfect mix to really helping power artificial intelligence.
When you talk about, though, power and powering artificial intelligence, you also have consumers who want their bills, obviously, to be at a certain price. How do you balance that?
Well, customer always comes first for us. So we own two main businesses. One is Florida Power and Light, which is the nation's largest rate-regulated utility. And we are all about affordability for our customers. And so we have a bill that's 30 to 40% lower than the national average and is only growing at about 2% a year. And we've been able to do that by making really smart investment decisions around generation, and we're very cost conscious. We take that same mindset outside of Florida when we're helping to power data centers. We give them a mix of generation resources that we think are the most cost effective. And one of the things that data center providers are coming to the market with is what we call BYOG, bring your own generation. We help them do that. So what they are doing is they're building their own renewable storage, gas-fired generation, potentially nuclear as well, and they're paying the full bill on that. So customers don't have to shoulder any of the cost. In Florida, we've developed a large load tariff where the hyperscaler pays all the costs associated with the generation and the transmission. None of it gets put on the customer.
So in terms of access to power, you just talked about how you provide it in many different ways. But do you think overall the U.S. is prepared to meet the demand?
I think so. I mean, the industry, is fully behind figuring out how to get power solutions at scale available to the market. And the administration is extremely supportive of this. This administration is fully behind energy dominance and driving energy dominance in the United States, and is really helping to drive permitting and help drive solutions that allow us to bring power generation alternatives to market quickly and affordably.
You recently spoke with investors about a target of 15 to 30 new gigawatts of new power generation capacity by 2035. That's not that far away. Are you still on track?
We are. And one of the things, a couple things. So one, we have a partnership with Google that we're very excited about. We're recommissioning a nuclear power plant with them. We have a joint development agreement with them where we're building out data center hubs. We're also collaborating with them on AI tools for our own company that will take the market to utilities in the U.S. across the globe. And we're working with them on an advanced nuclear collaboration. And then on Friday of this past week, we were awarded 10 gigawatts by the Trump administration to build out a 5-gigawatt facility roughly in Texas and about a 4.5 gigawatt facility in Pennsylvania. It's about $33 billion in investment to help power artificial intelligence facilities in both of those states. So something we're really excited about.
You've also been active in M&A recently, acquiring Symmetry Energy to expand in natural gas to help power that AI demand that you're just talking about. Are you looking to acquire more natural gas companies?
Well, I'll tell you, I mean, one of the things that differentiates NextEra is we're in every part of the energy value chain. So not only generation, we're in transmission, we're in distribution, we're in upstream oil and gas, we're also in gas pipelines. Because you have to have an understanding of the entire market, the entire energy complex. And Symmetry was a perfect fit for us. They're one of the largest gas marketers in the United States. That allows us to pinpoint with data and well-informed market information where to best locate new combined cycle facilities that can help, really drive and power AI demand around the country.
So, are you looking at any other M&As?
We're always in the market. We're always in the market looking for things that could add on and could supplement the skill sets that we already have at the company.
During this time of unrest and war with Iran, is raising capital becoming more of a problem with your investors?
No, I mean, we have a very disciplined capital plan. What we've told investors is that we're planning to raise, roughly a couple of $1 billion of equity a year through 2032, where we've given our financial expectations. And, we're investing substantial amounts of capital across the energy complex. As a matter of fact, we're the 6th largest investor of capital in the United States, behind only the top 5 hyperscalers. So nobody's doing more, I think, to really try to change the paradigm in terms of bringing power solutions to customers across this country. And capital is not a concern. Investors believe in our story. They believe in the growth. It's highly visible. We have 12 ways to grow. We have a very diversified company and a very diversified investor base.
Coming up next is the ETF report. We will zero in on 3 plays in the commodities space right after this with Mike Philbrick. Time now for the ETF report. Our next guest says broad commodities can help with inflation and geopolitical shocks, and gold remains the classic monetary hedge and portfolio stabilizer. So joining me now with 3 ETFs in commodities is Mike Philbrick, CEO at Resolve Asset Management. It's good to have you. Thanks so much for joining us.
Good morning, Lindsay. Great to be here.
So before we get to your actual ETF picks, I want to talk to you about gold, because obviously gold prices have been seeing some whiplash over the last couple of weeks because of what's been happening in the Middle East. You remain bullish, though. Why is that?
Well, I think that gold and the global economy still faces all of the trials and tribulations it did back in January. You've got central banks that are now going to have to face the dilemma of keeping rates a little bit higher to fight inflation, and that degradates the traditional bond diversification opportunity, which leaves you with gold as a diversifier. And that diversification impact is coming from the fact that we've got some sustained inflation, some supply disruptions, and geopolitical stress, which all lead back to gold. And remember when we chatted in January, when we were having that big spike, I did mention that, if you've been in it, great. You might want to sell a little and rebalance, but look for some sort of pullback, because most people and most investors don't have a position in gold. And this pullback represents an opportunity to start to build in that diversification for portfolios.
Interesting. Obviously, we've seen oil. The price has been under pressure because of what we've been seeing in the Middle East. Basically, everything we're seeing right now seems to have some connection with that war in Iran. What do you think is going to happen with the price of oil? Look how much it's spiked ever since the beginning of March. Do we really think it can get back to the levels it was at before the conflict began?
I don't think so. I mean, we've got a war-driven inflation shock that is really kind of rewriting the playbook on diversification and portfolios, much like the 70s. And so the idea that we're going to return to $55 oil might be a little bit optimistic. Possible, of course, but optimistic. And I think we've got to work through the disruption that we have currently. And that's accounting for, at the moment, 2% of global GDP. So it's not small. But we are working through that, and you're seeing in the price of both stocks and oil, it looks like the markets are anticipating some sort of resolution. And that's probably because it is very untenable on both sides of the negotiations for this to get worse. And so that drives a little bit more urgency to the negotiations.
But obviously, how long these negotiations take, if they are in fact happening, would affect the outcome in terms of what we see in the markets. Is that right? Like the longer this conflict goes on.
Absolutely.
Yeah.
Absolutely. The longer it goes on, the more dire it gets. I mean, oil is oil, and energy. Hydrocarbons are in everything. They're in your food. They're in your plastics. They're in the car you drive, and so on. So they're very important to the global economy.
Okay, let's get to your ETF picks now. Your first one is a BMO Broad Commodities ETF. What is it that you like about this one?
Yeah, ZCOM, or ZCOM, I guess. Basically, this is a diversified, broad-based commodity ETF that gives you exposure to everything from the energy side, agricultural commodities, and precious metals. And why it fits now is that, in a current macro shock like we're experiencing, where you have it being more about inflation than it is recession, commodities are one of the few places investors can look to get direct exposure to those rising input costs. The supply disruptions, the geopolitical stress, all cause these commodities to rise in price. And this is the cleanest way to express that view and keep it clean in the portfolio. Now, you have to keep in mind commodity returns can be cyclical and volatile as well. So it is a part of the portfolio that can diversify those stocks and bonds, because if we enter a 1970s-like environment, stocks and bonds become correlated. They go down together, like 2022. But what often happens is if you have inflationary pressures, those commodities do go up in price, and that helps the portfolio be more stable.
Interesting. Okay, and as we continue this conversation, particularly about gold, your next pick is CI Gold Bullion Fund.
Yeah, that's Vault, V-A-L-T. And again, this is a physical gold exposure through an ETF. We've talked about this for probably 3 or 4 years. Gold remains the classic hedge against that monetary instability, geopolitical stress, and the declining confidence in traditional policy anchors, if you will. So this is providing a real piece of diversification beyond just your stocks and bonds. And with Vault, the nice thing here is the management expense ratio is around 17 basis points. So it's probably the cheapest one in Canada that can be bought. So nice, cheap, cheerful, and exposure to that bullion in your portfolio to provide better diversification.
And something that really hasn't been talked about as much as gold recently is silver, which has been seeing its own shares of volatility, I guess you could say, ever since this war broke out. But that's your last pick, is iShares Silver Bullion ETF. So what is it that you like about this one? Correct. So SVR/C, and that's the physical exposure to silver in an ETF format. And so silver is a precious metal like gold, and why that fits is because it has both a monetary metal aspect to it, as well as that industrial demand story, which we're talking about the electrification, infrastructure spend, and hard asset scarcity and build out that's going to be required in an AI world. And so silver gives you a little bit more volatility than gold, and it can behave a little bit more like a risk asset. So during growth scares, it can come off a little bit. But just as we talked about back in January, there was this big run in silver and gold. And we said, well, maybe pause, but do keep an eye on these assets for some sort of pullback where you can start to build your position. Crawl, walk, run. If you have 0 in your portfolio, it's time to probably get some precious metals and commodities in your portfolio. If you've got some and it's come down in price, well, rebalance and add back up to your allocation. I just want to get your thoughts on silver in general, though. Is it smart to treat it kind of as people treat gold, as a kind of safe haven, a place to go when things are looking a little bit uncertain, or is it not quite as safe as gold? It's not quite as safe as gold. Silver has this dual personality. It's a little bit of a monetary metal, sort of that store of value, but it also has a large slant towards industrial demand and that story that's coming from electrification, the story that's coming from the infrastructure build out. It's used in power, it's used in computer components and all of that sort of thing. So the demand side is quite strong, as well as it being a monetary metal. That's going to give it more oomph, more beta. So it's going to be a little bit more wild than gold, but you're going to reflect that in your position size. So if your position size of gold was 10%, maybe your position size in silver is 5%. So you're going to want to reflect that position size to account for the higher volatility that silver brings to the table. But it brings that dual mandate. It's kind of got that commodity side to it where it responds to industrial demand, but it's also got that monetary side where it behaves a little bit like a store of value as well. Interesting. Okay, Mike Philbrick, CEO at Resolve Asset Management. Always good to get your insight. Thanks so much for joining us. Appreciate it. Thanks, Lindsay. Up next, we'll have your latest headlines and we'll update you on the market. Stay with us. Shares of Dollarama are seeing some pressure today. That's after the discount retailer posted same-store sales in its latest quarter that came in below estimates. Dollarama says unfavorable weather conditions negatively impacted store traffic. On the upside, it beat profit and revenue expectations and boosted its dividend. And shares of Boralex are getting a boost today after the renewable energy firm confirmed it is conducting a strategic review of the company. Bloomberg is also reporting the options could include the company going private. Boralex has a market value of about $3 billion and has a number of new projects in development. And AtkinsRéalis has received a contract worth approximately £98 million from Britain's rail infrastructure owner, Network Rail. The Montreal-based company will work to upgrade signaling and telecommunications infrastructure in South England. Atkins will also deliver end-to-end design, project management, and construction services over 3 years. And we're watching North American markets closely today. The TSX seeing a bit of a boost now, ever so slight boost. The S&P 500, though, and the NASDAQ still trading down today. The NASDAQ almost by a full percentage point as investors and traders are weighing what we're hearing from both sides when it comes to the conflict in Iran. And that's where we're going to start off today. U.S. President Donald Trump has put an ultimatum to Iran on hold, claiming that talks on ending the conflict have been going well. But Iran denies that any talks have even taken place. ABC's Rachel Scott has more in this report.
This morning, conflicting messages from the U.S. and Iran on whether talks to end the war are taking place.
We have had very, very strong talks. We'll see where they lead. We have major points of agreement. I would say almost all points of agreement.
But Iran insists that no talks with the U.S. have taken place, saying anything otherwise is an attempt to influence the stock market and the price of oil. President Trump now giving the country until Friday to make a deal to end the war, backing off his threat to hit and obliterate key Iranian electrical plants if the country did not reopen the Strait of Hormuz by last night.
We're doing a 5-day period. We'll see how that goes. And if it goes well, we're going to end up with settling this. Otherwise, we'll just keep bombing our little hearts out.
4 weeks into the war, the Strait of Hormuz, where 20% of the world's oil flows, is still at a virtual standstill. President Trump insisting if a deal is reached, the strait will reopen.
And who's in control of it? Will Iran still be able to control the flow of oil?
Be jointly controlled.
By who?
Maybe me. Maybe me.
You want the United States to be in
me and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and there'll also be a form of a very serious form of a regime change.
The president says his son-in-law Jared Kushner and special envoy to the Middle East Steve Witkoff are leading the ongoing talks with Iran, but he will not say who in Iran they are talking to.
We're dealing with the man who I believe is the most respected and the leader. It's a little tough. We've wiped out everybody.
Is that the Supreme Leader?
No, not the Supreme Leader.
Rachel Scott, ABC News, Washington.
Markets are down today, but both the S&P 500 and the TSX saw significant gains yesterday after President Donald Trump said the United States has talked with Iran about a possible end to their war. CTV's Tyler Barrow has more on how all of this has been affecting prices here at home.
As President Trump says a deal to end the war with Iran may be close, the markets take another big swing. On Monday, Canadian and U.S. markets rose sharply as the positive news gave investors a reason for optimism.
It's going to go in every direction, depending upon the rhetoric, the conversation, and potentially negotiation and agreement at some point in time.
Trump says he will postpone hitting Iran's energy infrastructure for 5 days to allow for negotiations. Investors are watching closely.
Definitely pay attention to it quite a bit. I would say it is a bit concerning.
Very concerning, and I wish I could say I was doing something more active, but honestly, mostly trying not to think about it.
Definitely is affecting my investments. I'm concerned in the short term, but in the longer term, I think it might be beneficial.
As turbulence moves the market up and down and up again, financial experts are telling their clients to consider their timeline and risk tolerance.
Really understand that if you're down 20, 30%, is that comfortable to you given the position that you may have, given what's happening in the market?
While the markets are up, West Texas Intermediate oil dipped below $90 a barrel on Monday. Throughout the city, fuel ranged in price as Gas Buddy had the lowest pegged at $1.49 a liter. Other stations selling for over $1.75. As oil prices fell, drivers should expect gasoline prices to follow.
Come Wednesday, gas prices are going to fall net 14 cents or more a liter. Diesel could fall as much as 19 cents a liter.
Good news for those trying to cut costs.
Trying to avoid road trips as much as possible and just trying to stick around from closer to home and potentially carpooling.
Tyler Barrow, CTV News, Calgary.
Coming up next is Hot Picks. We will zero in on 3 plays in the mining sector with Cole McGill at Stifel Financial. Right after this, stay with us. Welcome back. It's time now for Hot Picks, and today we are zeroing in on 3 plays in the mining sector. Our next guest has picks in copper, gold, and lithium. So let's get more perspective from Cole McGill, Mining Equity Research Director at Stifel Financial. It's good to have you join us. Thanks so much.
Thanks for having me. Good to be back.
Before we get into your actual hot picks, I just want to talk about, the metals sector as a whole, like gold down today, copper down, lithium down. But you say this has the potential to benefit forward-thinking investors. Why is that?
Yeah, I think the way to kind of preface investing within the commodities equity space right now is to kind of take stock of the fact that we've seen a lot of the froth come out of the market, but the central tenet towards the thesis, which is revaluation of hard assets, hasn't changed since the war in Iran began. The Strait of Hormuz is pushing energy prices up. That's going to have an impact on margin expansion with respect to a lot of the miners. But the central tenet towards de-dollarization, towards global bifurcation, electrification, especially in the East because of energy prices and diversification of energy sources, I think is going to be a continuing trend and represent secular upside over the next, call it, mid to long term.
What about potential rate decisions further down the road? Obviously, the war in Iran is influencing how the central banks are kind of thinking of things, so it's hard to tell what's going to happen. But does that have any effect, or do you watch for that in terms of what's going to happen with the price of metals?
Yeah, 100%. That has a definite impact with respect to near-term gold upside. But again, I think that the central tenet, again, being that de-dollarization, being the broader macro theme towards revaluation of hard assets, kind of underpins the kind of upside towards gold exposure as well as copper exposure.
Okay, so let's get into it then. Your copper pick, we'll start with that, is ATEX Resources. What is it that you like about this one?
Yeah, so ATEX Resources is a pre-revenue, they're a development exploration stage company with a large asset in Chile. Chile is home to around 30% of the world's copper production. Chile and Peru account for almost 50%. And they're home to kind of the legacy assets that have kind of produced a lot of the secular growth and expansion within supply expansion over the past 25 years. ATEX's flagship asset is their Valeriano project. That's around a 33 billion pound porphyry. So for perspective, that would be a top 10 undeveloped asset globally. And really what's kind of taking their asset to the next level is the recent discovery of some of the near surface higher grade mineralization. That I think has the ability to increase competitive tension for the asset and really drive multiple expansion with the name and kind of the thesis behind what we're seeing with respect to metal expansion is since 2020 or so, we've seen a kind of geologic understanding whereby drilling deeper within the kind of epithermal porphyry continuum in the Andes through the likes of NGEX's Lunahuasi, NGEX's Los Helados, Filo Mining's Filo del Sol project, which was a $4.5 billion acquisition by BHP and BHP and Lundin back in 2024. There's been upwards of $12 billion of value creation within this thesis, and I think ATEX is prime for some of the secular rotation down cap towards a kind of $1 to $2 billion names. And I think you can see good downside protection within the name with respect to that Filo transaction, and then good upside with respect to the fact that they've got some really strong horsepower geologists powering a drill program that's really in the meat of it right now. And we're expecting some good drill results over the next 3 to 4 months.
And obviously, when we're talking about the story of copper, there's high demand for it, not a lot of supply. But obviously, we're hearing about all these big companies spending more on AI, which of course you need copper for all of these data centers, everything involved with that. Are there any risks at all with this company, and maybe related to that or maybe not related to that?
Well, I think that's the interesting aspect with respect to growth is if you go back over the past decade or so, you've seen a prioritization of large miners to prioritize large capital, return of capital to shareholders. You've seen muted volume growth within the likes of BHP, Rio, Antofagasta, and Freeport. And really what you've seen since kind of 2020 or 2011 to 2012 is an increase in buybacks, an increase in shareholder distributions, repairing of balance sheets, and minimal investiture within growth. And so that presents an opportunity for the kind of down cap, pre-production, large scalable developers, I think that can kind of fill the next wave of supply. And kind of for perspective here, if you go back to 2000, the average grade of the top 20 copper mines has dropped around 30 to 35%. So you've seen reserve grade drops, you've seen lack of investment within new supply, which I think presents a really good opportunity for the kind of earlier stage single asset growthy development and exploration stories that will likely need to be acquired to support new growth within the next cycle.
So interesting. Okay, your next hot pick is the gold pick for today. So Montage Gold, obviously, gold is just in general a very interesting story right now. Usually is.
Yeah, and so the way I kind of think about alpha with respect to the next cycle is that of looking at single asset developers that are transitioning towards the producer stage, which get a revaluation from being valued on a price and asset value basis to a price of cash flow basis. And you've seen this thesis work with a lot of single asset developers where they outperform the GDXJ and the GLD pretty significantly, upwards of 90% in the 2 years prior to commercial production. That same re-rate thesis is really what's been playing out with Montage. And I think the fact that stock has kind of sold off upwards of 25% over the past month presents a pretty good buying opportunity for the name going forward. For perspective here, you can think about development assets with respect to the three quote-unquote Ps, people, process, and property. The property is Kone. It's a Cote d'Ivoirian single asset developer. Good access to infrastructure. Majority of the capital has been spent on the project. They're around 60-65% on the way through production, with first production expected towards the end of the year. The people and the management driving the asset forward is kind of a triple threat of an old Endeavour Mining management team that's kind of recapitalized this asset and brought in the CFO, the CEO, as well as the Vice President of Exploration, who's explored and discovered over 15 million ounces of gold within Ivory Coast. And then their CEO, Martino De Ciccio, has helped finance this asset in a way that really has minimized the exposure to debt and equity through financing.
Okay.
So you're left with an asset that has an ability to grow. The market's really pricing in effectively their scoping study from 2024, but I think there's a lot of upside with respect to production growth for the asset and mine life extension. And then finally, what I think really kind of takes the asset and the company to the next level is the fact that the market is now starting to price in a change in business model for Montage. They're kind of in the early innings of shifting from effectively a single asset ramp to a self-perform value uplift model through some of the investments they've done with respect to consolidation of African gold, of Aurum Resources, and a few other names. So they're really becoming the kingmakers of new value creation within Cote d'Ivoire in West Africa.
We are out of time, so I'm going to ask you to be quite quick with this last one, but your last pick is Lithium Argentina. What does it you like about Lithium Argentina?
Yeah, so Lithium Argentina, we've seen a rebound with respect to lithium prices due to new demand drivers entering the market and kind of layering on top of EV, which is predominantly energy stationary storage, which is directly linked to AI and increase in power consumption. Energy stationary storage is growing at around 50-55% on a year-over-year basis. That's really driving the uptick in lithium pricing. The way I like lithium exposure right now is if you can look for assets and companies that are low on the cost curve and an ability to deleverage and transition to a free cash flow inflection point. That is Lithium Argentina. They've ramped up the asset, which is Cauchari, fantastically well, faster than a lot of other comparators within the region. And they've got two growth projects I think the market's going to start to revalue as pricing starts to unlock the balance sheet.
Okay, so interesting. Cole McGill, Mining Equity Research Director at Stifel Financial. Appreciate your time. Thanks so much.
Thanks for having me.
Coming up, we'll tell you about an opportunity for Canada to add billions to its GDP with new pipeline capacity. That's next. Stay with us. The federal government has a long list of projects that it is assessing, among them a new pipeline in the West. ATB Financial's Mark Parsons says increasing pipeline capacity in Canada could add more than $30 billion to real GDP each year and over the next decade, and he joined us earlier to explain the opportunity.
What we did is we looked at the pipeline costs. You know, if we did the West Coast pipeline, that's 1 million barrels per day. 500,000 would come from other projects. And more importantly, what does it cost to fill a pipeline of that size or pipelines of that size? And we estimate about $100 billion of upstream investment. So that's where the biggest kicker is on GDP, is actually like filling the pipeline with new investment. Okay. And of course, we get the exports after you build the pipelines.
There are a number of things, of course, that would have to fall into place for this scenario to unfold, and it would have to be on a tight timeline. When, with your scenario, would construction have to begin?
Yeah, so we don't assume anything happens this year. This year, there's a bunch of things that have to happen. There's the April 1st deadline, which is coming up with the MOU on the Pathways project. And then July 1st, the West Coast Pipeline is going to the Major Projects Office. So we expect pipeline construction to start in 2027 and then kind of scale up to 2035 timeframe.
Okay. What would be the cost to the government for infrastructure? And does this scenario involve private partnerships?
Well, I mean, it would include obviously private partnerships. We think the Indigenous communities would, have an equity stake in these projects. Whether there's government money or not is to be determined. We do think the demand for Canadian heavy crude is there in the Asian market. You're seeing that with the Middle East disruptions right now in the Strait of Hormuz. You actually had a light-heavy differential narrow. So the demand is there. You just have to make sure that we build the pipeline, within a reasonable time frame and on budget.
Okay, so we're talking strictly about a pipeline right now, but what would be the build-out around that?
Build out around the pipeline. So in addition to the pipeline, we do expect, because it goes hand in hand with the West Coast Pipeline, the Pathways project, which would be carbon capture and storage. That would lower emissions intensity per barrel. So that would add additional investment to the economy, not so much, on the production side. That's more of a carbon capture project. But it is basically a license to, build that pipeline and then fill it.
Mark, what are you putting the price of oil at when you're running your scenario? And I'm asking because we've seen such fluctuations over the last couple of weeks. That being said, the price of oil over the last year was depressed. So what are you gauging it at?
Yeah, we ran this based on oil averaging like $60 to $70 per barrel over the time period of study. So we're not assuming that current prices stay with us. We kind of level out over the time period. I think what's important to understand is this analysis is just kind of a net new impact. So if we're able to get this additional pipeline capacity, we feel like these barrels can come onto the market at around that $60 to $70 price range and be cost competitive.
Talk to me about who needs it. You mentioned Asia. I'm wondering whether you're looking at this solely in the eyes of exporting to Asian nations, or are you looking at other clients or customers as well?
Well, part of the build-out on the mainline system, with Enbridge is looking into that, would be serving the North American market. But we see, of course, the West Coast would primarily serve the Asian market, where those, as I mentioned, those heavy barrels are in demand. And I think what's really important to understand is that Canada has been, for the most part, selling to one customer. What this does, in addition to the economic impacts, is it gives us optionality, meaning we'll get a better price by sending our product to new markets, and also reduces our risk. Right now, we have single customer risk or concentration risk. So we saw that with the Trans Mountain expansion, with the light heavy differential narrowing. We'd see that again with additional pipeline capacity going to Asia.
Where do you see employment for this?
Well, primarily oil and gas industry. The bulk of it, we'd see it in Alberta because we think the oil sands would be, meeting that additional demand for the most part. But it spreads across the country, right? You have to import equipment. You have to have labor from other provinces. The build out of the pipeline, a lot of that would take place in BC. So it'd be, oil and gas upstream, but also engineering services, transportation services, right through to retail and even housing.
Okay, so I guess the biggest bonuses would go to first Alberta and then BC as far as GDP for them.
That's right. But I think there's an opportunity here because we import a lot of equipment to kind of build out the oil sands. If we're able to get, Canadian steel, aluminum, other products from the rest of the country, especially in the middle of a trade war, I think that's a real opportunity to knock down those interprovincial trade barriers and source more of the material in Canada.
That was Mark Parsons, Vice President and Chief Economist at ATB Financial. And that wraps up this edition of The Open. Morning Markets with Roger Peterson is up next.